The Federal Reserve made its move, cutting rates by a quarter point and signaling that more easing could be on the table. Powell called it a risk management cut, leaving investors debating whether this was the start of a cycle or just a cautious adjustment. Now the focus shifts to the data in the week of September 22nd through 26th, which will either confirm or challenge that narrative. On Tuesday, September 23rd, existing home sales will show whether lower rate expectations are starting to filter through housing. A rebound here could boost homebuilders and construction names. If sales remain sluggish, defensive plays may stay in favor. On Thursday, September 25th, durable goods orders and trade data take the stage. Strong durable goods would hint that businesses are still investing, which could support industrials and semiconductors. Weak numbers would add to recession fears, pressuring cyclicals but supporting the Fed's case for another cut. The real spotlight lands on Friday, September 26th, with personal income, personal spending, and the Fed's preferred inflation gauge, the PC price index. If income and spending soften while inflation cools, it reinforces the case for more cuts and likely fuels gains in tech, real estate, and consumer discretionary. But if inflation proves sticky and spending stays strong, expect yields to rise, the dollar to firm, and a rotation into value, financials, and defensive sectors. So what's actionable? Investors should prepare for volatility around Friday's release. Hedge exposure, and be ready to tilt portfolios depending on the outcome. Soft data and cooling inflation favor growth and duration. Sticky inflation and resilient spending favor value, banks, and defensives. The Fed has opened the door. This week's data will determine whether they walk through it. This is not financial advice.